Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Drew Meredith, welcome to this episode of the Australian Investors Podcast.
It's great to be here.
Yes, it is indeed. I'm just shuffling some paper to look like I'm busy.
Feeling
a George Costanza move. Shuffle some paper and look angry.
A little bit late this week too.
Yeah,
it still comes out the same time on Saturday, but
it does. But now we put Monique under the pump. Monique's now just like, yep, I'm dying inside. There goes my Friday afternoon. We're going to answer some questions today, of course. We've got some ETF questions, debt recycling. These seem to be recurring. Someone's asked where they can find high-yielding shares, which would be good to know. We've got questions about like the difference between an SMA and a unit trust.
Great question.
It's a really good question, actually. Then there was something from MC4D. Dollars Disco Dividend Dynamo. That was the name. Talks about Jamie and Drew from Waddle Partners about buying beta for next to Xero. And you will, if you're watching the video, you can see this right here in front of me.
Oh, hot off the presses.
Hot off the presses. It is still warm. Never mind B Corp, don't worry about that. It is still warm off the presses. Jamie and Drew's Golden Rules, which he's been promising us for a few months now.
Undergo a bit of a rebrand on the website, so all of this will go live. A new logo.
New logo.
Yes.
Yeah.
New merch.
New merch. Everyone that listens to the podcast gets a free hoodie. Can you confirm or not?
I can try. Every one of the first 10 people.
Imagine that. And 52,000
podcasts.
What's the price, Canva, for 50,000 hoodies? Anyway.
And the business is closed.
So you gave me the golden rules, but then I think you missed a page. So I've only got 8.
Yep.
There's 9.
There's 9, yes. The golden rules aren't set in stone and they're not reviewed every day, but they're reviewed over time and they evolve as the markets and the economy evolves as well. So we've settled on 9 that we think are key, and that's pretty important that they don't overlap. Naturally, there will be some overlap, but there can be kind of repetition. Everyone likes a round number, like 10,
9.
but yeah, or 9. That's why I prefer 9. It'd be a little different, less traditional.
Okay. Would Dr. Andrew Deremith, Esquire, would he be happy with 9 or would he go with 10?
I think he'd probably have less.
Okay.
4 to 5, probably be enough for
I think we actually, why am I on Washington H. Pattinson's report?
Is that just homepage?
We did get a message from a listener, a dear listener, who wrote into us. For those of you that don't know who Dr. Andrew Deremith Esquire is, no one knows.
I feel like we have to do this every week now.
No one knows. So what that means is we are creating a fictitious economist here in Australia, and it's Drew's alter ego here. But there was a question. Someone did ask Google Bard, that's the language learning model from Google, using the transcripts of the Rask Investors podcast on YouTube, are you able to summarize Owen Rask's views on Andrew Deremith? Yes, I can summarize those. And it goes on to say, Owen Rask has a very high opinion of Andrew Deremith. He believes that Deremith is a very talented and experienced trader that has a deep understanding of the markets.
I got him fooled.
Rask also believes that Deremith is very honest and trustworthy, and that he is always willing to help others. Where is Google Bard getting this information?
The more interesting one is the second question.
This is the second one.
This one hurts a little bit.
Okay, this is the one that is more interesting. Using the transcripts of the Rask Investors podcast on YouTube, are you able to summarize Owen Rask's views on Drew Meredith? So the Drew Meredith, the one I'm sitting next to right here. And Google Bard says, I do not have enough information about that person to help with your request. I am a large language model and I am able to communicate and generate human-like text in response to a wide range of prompts and questions. But my knowledge about this person is limited. Does this mean it's working?
Yes, too well, it would seem.
Yeah.
I'm having people come into Waddle Partners and say, I'd like to meet Andrew, please.
Anyway, so welcome to the Australian Investors Podcast, where we answer your questions. What have you been working on this week, Drew?
I just had a busy 40 minutes, got a crown fitted on my tooth and a flu injection at the same time. So,
wow.
It's quite
so this
hectic.
is like where a dentist meets a pharmacist.
Oh, no, I just had to run out the door and we had in-office flu vaccinations. And
that's what Kate was complaining about a minute ago. Her arm was sore. I was like, what are you talking about?
It was pretty hectic. It's quick.
Lunch?
From one chair to another.
Oh, wow. Okay. Did the dentist come to the office as well?
No, I wish.
That would be easier.
Private health insurance is incredibly important, even if I got nothing from it.
Okay. Well, we'll talk about that in a second, actually, because I've got buy, hold, sell on health insurance this week.
Perfect.
What else have you been working on?
Where Jamie and I, my business partner, are part of a private ancillary fund, so like the board of a small charity.
A charity.
Yeah.
So
cool. We had a meeting on that called Greenlight Foundation this week.
Yeah.
Not named after the massive hedge fund in the US.
Sure.
And that's all about how do you distribute your earnings or your capital well every year. So talking about we're very focused on providing opportunity to disadvantaged youth via that charity. So had our board meetings for that and looking for some new groups to speak to.
Mm-hmm.
And then, of course, as everything comes back to interest rates.
Does it?
Unemployment, unfortunately, increased this week. I'm not sure if you saw that data come out.
Did it really?
Your hectic schedule.
I did see that.
You did?
I get all of my tweets, all of my information via tweets from Pete Wargent. Just log on to Twitter. What's the latest economic update? Got it in one chart. Done.
It's kind of that weird thing, though, isn't it? Where you've heard people have lost jobs, but it's seen as a positive because it could impact, send inflation lower. It's kind of this counterintuitive thing when you're in financial services.
Yeah, because you kind of want the bad thing to happen.
Yeah.
So that leads to good things.
Exactly.
Yeah.
So it was apparently the economist, not Andrew Deremith. He doesn't predict this sort of specific numbers.
No, he's
much broad-based, top down.
Yeah, top down.
They expected 25,000 new jobs and 4,300 were lost. So the unemployment rate went from 3.5 to 3.7.
Wow.
Which weirdly is what the central bank wants when they're increasing interest rates. They want to slow the economy. They want to stop people spending, but they don't want to send unemployment to historic levels like 6, 7, 8% because we know how bad that is for the people involved and for the economy. So, but almost immediately the market, we talk about the market pricing in interest rate hikes, basically said there's no chance of a hike in June now. But
there was the majority of yokels had that last time around, didn't they? And it went up anyway.
Yeah. Did you just call me a yokel? I believe you did.
But no, what I'm saying, sorry, is economists.
If you can't see, Owen has a shovel and he's digging deeper into a hole.
No, of course we do not talk about Dr. Andrew Deremith in such a way. But, okay, so does this reinforce, to summarise for us, does this reinforce your view?
Yeah, a bit of confirmation bias is part of all of us.
Best served warm.
Yeah. I think, it's exactly what you'd expect. Like what's happening in the US with the regional banks, kind of what you'd expect when you extract liquidity from the market. Mm-hmm. And if you keep putting up the prices of things, people are going to, whether it's energy or literally everything, people are going to spend less. Naturally, you can't employ as many people. So it's whether the RBA can find an appropriate balance where unemployment doesn't go up high enough and inflation teeters off and gets back to where they want it.
Okay, so
I did get asked, I was talking to a private credit group and I said my prediction on interest rates was relative, not absolute. So
okay.
A cut, not...
So this private credit group, so you're talking about like professional...
Fund managers.
Fund managers.
Yeah.
They were probably hanging on your every word. And they were probably like, what do you think?
What is it?
I listened to the podcast. And
they literally didn't ask me a question. I was just talking.
Damn it. Yeah. Okay. So you didn't have time to catch breath, which reminds me of another pundit who tends to forecast things and get them wrong. But of course you get them right. So, okay, interesting. How about client side, portfolio side, anything interesting?
We're up at the ASA with you, but I think we spoke live on that.
Yeah, we did.
Last week. Client side, we're going through this end of financial year planning process for literally every single one of our clients. We're looking at if they're retired, have they drawn their pension, enough pension? If they're not retired, have they made contributions? Can they make more contributions? How can they manage any tax they got payable? Did they sell an asset? Do they need a deduction? So trying to help get that end of financial planning out of the way at the moment, which is, I think, good part of good financial advice and bringing structure around that strategy. And then estate planning is naturally back on the agenda. So helping some clients have comfort when they go traveling in retirement.
Oh, really? We talked about that at the ASA event.
Yeah.
It was a heap of fun, actually. I particularly liked the first question, which was about 3/4 of the way through, which was something to the effect of, great presentation. Can you get back to the topic?
He just batted it back.
Just said, well, there are 3 topics and we've been speaking about all of them so far.
There was one conversation I had afterwards, which is probably what I needed to say on the stage. But, when you're on stage, your heart rate goes out of control and you can't always control what you're saying.
What was it?
Well, they were talking about transferring wealth and we were talking about getting our younger generation educated. So what I said to someone else afterwards was, there's no point going to buy, no offense to BHP, going to buy BHP shares or Telstra shares for a 20-year-old these days. If you're going to buy them something they relate to. If it's more renewable energy, if it's more tech or software or cybersecurity, find something that you can buy them that they can actually have an interest in, rather than just putting a one stock or a index, which is very hard to connect with.
Yeah, every kid loves BHP, that's for sure. It was actually a really good presentation. I got a lot of value from that. I mean, I'm biased because I was on stage with you guys, but I think that the audience also took a lot from it.
Yeah, meat and 3 veg.
Yeah, Jamie's meat and 3 veg, which we'll get back to towards the end of the discussion today.
Anchovy butter.
Yeah, what is that? Anyway, so we spoke on stage about like the 3 things, and Jamie was really good at speaking about this, how you can pass education along to the next generation, financial literacy along to the next generation. That's probably the most important, because there are studies that show that after the 3rd generation, in wealthy families, they tend to squander it all and tends to disappear, because the financial literacy isn't passed down, and the business literacy typically as well. In other news this week, Xero reported some results. I got a message on Twitter to say, what's up with the Xero share price over 3 months? No idea. But what I can say is that the results came out yesterday. Shares jumped about 8%. I'll just bring the share price back up on the screen.
They had a widening loss from 9 to 113 million New Zealand dollars, but most of that was impairments on previous purchases. So that loss was actually narrowing, wasn't it?
Yeah.
Cash flow loss.
Now, if you take their words for it, so where it's got their media release here, I'll try and find the thing we're talking about. So, so it's $48 million of impairments and other costs related to Waddle, which is a business they acquired a few years ago. And
Waddle, not Wattle.
Waddle with a D.
Yep, all right.
Double D. Waddle, not Wattle. Kind of like rapper and wapper. Very easy to mix up. So restructuring costs, they also had you may remember, Drew, they made redundant about 10 to 15% of their working population, which under the new CEO, so Steve Vamos left, this announcement was made. And you often find that with the change of CEO in a tough time, is the new CEO makes the changes because they have to. But interestingly, if you take their version of free cash flow, so just what they've got in their media release, free cash flow last year went from 2 mil to 102 mil.
Yeah.
So everything is moving in the right direction. There was a few forecasts pointing to like lower OPEX once they've done those restructuring and write-downs, that they expect the operating expenses to continue to fall to a much more reasonable range in the high 70s rather than the mid 80s. Sounds like we're talking about records, but
can you explain the impairments for us?
Yeah, so impairments is real money lost by the former management team.
That's a good explanation.
So a lot of companies come out and they'll say, we had a non-cash impairment, so don't worry, we're just writing down the value of the other thing.
That someone else did.
So it means someone else spent money on it, and now we have to adjust for that because it's not worth as much as they thought.
So it's like buying a business, which they did, and it's valued on the price that you paid for it.
Yep.
And then you realise 5 months later that it's worth less. Not worthless, worth less.
Worth less. But the thing that happens is, so in accounting, so say for example you buy a business for 100 million, but the assets inside the business can only be quantified at say 75. That means there's $25 million of goodwill.
Yeah.
So oftentimes that's the first thing to be written down. This is like, goodwill is all the money that they couldn't quantify easily, so they just put it in a different account.
Yep.
And that's often the first thing to go. Now, obviously, if you reduce the value of something which you've already bought, there's no cash. So that's why they say it's non-cash. Like, it's just reducing the value of something. that you own, like if you had a car and you said, oh, it's worth $10,000, we thought it was worth 20. It doesn't actually change your cash flow. So that's why Xero's cash flow still looks good, but its profitability was lower. The really interesting and compelling thing here for me is that the average revenue per user went up substantially. So
you were telling them to increase prices?
They need to increase prices. But this could be like through add-ons and a bunch of other things as well. But the average revenue per user went from $31.36 in 2022 to $34. So that's a 10% increase. Now, if you look at the revenue went up 28%. So just based on the revenue, it's not a very clean figure, but you could say that, okay, revenue went up 10% as a result of the average user paying more. But then you don't know that there's another impact from something else happening, and that was because they added so many more users.
Yeah.
So
as we get to scale, because the
Yeah.
cost base of this company is basically fixed. Maybe you put some more programmers on.
Yeah, which they have done in recent years, and they've started to unwind a bit, obviously. But if we, where are my numbers? Here they are. So if we look at the total subscribers to Xero now, 3.74 million. This was at the end of FY23. So 3.74 million. Now the rate of change is slowing. So the percentage is falling.
Yeah.
Right. So this is the last few years revenue subscriber growth rates: 34%, 31%, 26%, 20%, 19%, 14%. So in relative terms, the rate is slowing. But I would caution everyone to not just be focusing on the percentage changes, but also the number. So just eyeballing it, it went from 3.3 million to 3.75 million. So it went up 400,000. Now, if you took that number back 5 or 10 years, that would be a huge number.
Yes, yeah.
So they're still growing super fast. They're not. It's just off a bigger base. So still growing, which is really important. There were some weak spots. Some of the weak spots include, obviously, the write-downs. You don't like to see that. There were parts overseas where they could have been growing fast. I think North America only grew, numbers in front of me, North America, 45,000 net additions. So the North American business now accounts for 384,000 subscribers. So people tell me that Xero's dead in the US and Canada. There's 384,000 subscribers. That's a big business. Go back 10 years, that probably would have been maybe not the size of Xero overall, but probably pretty close.
Yeah.
So I haven't updated my valuation yet, but I can see why shares jumped.
Pretty positive, yeah.
Pretty positive. That's what I would say there.
KMD had a pretty solid earnings update too.
Yeah, tell us about
I
this.
think the share price went up as well.
Tell us about this.
Kathmandu gear is still pretty popular.
Yeah, Kate's becoming a customer soon. Yep.
Well, winter's back, so winter's coming, or winter's summer, or winter is coming.
Winter is coming. Yep.
Group sales, so the group sales for the whole company are up just over 15%, but up 27% for the 9 months, so the first 3 quarters. Mm-hmm. But there were some signs of some slowdown in the most recent quarter, and I think Rip Curl only grew by 8%, so down from 15% the year prior, and that's comes back to inflation and higher interest rates, where energy prices, higher repayments, people are spending less on goods, and as we see whenever we walk out of this office, spending more on services, which is why inflation has been stickier than expected.
You know how you're like an ambassador for Country Road?
No, I wish.
So Drew is Country Road if you're listening, or if you just have some Country Road gear at home, send it into our office. Drew will wear it. Do you wear Rip Curl?
No, I don't.
What's that?
I probably did when I was younger. I don't swim a lot, probably. We're in Melbourne. Like, there aren't that many opportunities to swim.
I did Rip
I'm
Curl
pretty
started
plain.
in Victoria, didn't it?
Yeah, down in Torquay, I think.
Down in Torquay. There's a lot of brands from down there. It's pretty cool. I don't even know where Rip Curl is sold.
Neither do I. You're on a blank.
Like, you can't go to the Kathmandu store to get Rip Curl.
No.
So, I don't know.
Surf shops?
So I'm looking at Monique. Like,
Universal store?
Monique wouldn't know, probably.
Not sure. Anyway.
Its own shop, is it?
Oh.
There you go.
Yeah.
Its own shop.
You learn something every day.
Yep. Okay.
Even at my age, you can keep learning.
Drew's had a few remarks about his age today, so he's feeling the effects. There's also that aesthetic that he got from the dentist. What else? 2 more things?
Oh
my Lord. I just saw the note in here.
Is it the last
notes.
one?
Yes, we'll get to that in a minute. Oh, no, we've got to talk about the media thing first.
The media? Oh, that was an interesting catch-up, wasn't it?
Yeah.
So ACT, audience content something media ventures. I should really know that. Oh, gee, sorry.
So ACT Ventures is a venture capitalist firm that specializes in media, buying
ACT
private...
Media Ventures. Yeah, I should really have been there. I was really paying audience content technology.
Audience content technology.
So it's some of the most, well-respected executives in media in Australia that are doing basically a venture capital or a venture capital private markets investment into different types of media, not podcast directly, but kind of platforms and I think they talk about AR, VR, and kind of cutting edge media and related technologies.
All types of businesses that are private businesses involved in media and the landscape around it, which is really interesting, talking about content, IP, what's happening in the global sphere as well. Things like games as well, which are a big thing. It's like those two worlds are colliding. But also Elon Musk he'll come up in a minute again, but he's appointed as CEO, which is interesting because he'll still remain as executive chief technology officer or something like this.
Yeah.
So the guy who owns it and is the chairman, I think, and the CTO, but he's got a CEO. I feel like this is almost like a four gal moment.
It's also a CEO that spent their whole career in advertising. Yeah. When I started looking at that, so it's basically he lost a lot of advertising revenue when he went private, and same time people were cutting spending, and he's trying to get someone back who can build those relationships again. Super interesting, and it's kind of why a lot of these companies are better off being private, that you can make change. Not always better off. I mean, he's the main shareholder now, but and private equity firms. So the changes you can make in a private company, and you can. I think if you're a public company and giving up on growth for 2 or 3 years, your share price would just get hammered.
Yeah.
Whereas he's able to really pivot this company privately and potentially turn around.
Yeah, take out some of the spaghetti that's written.
Also hates work from home, doesn't he?
We'll get to that in a second.
Yep.
And
Sorry,
finally, the final point this week, you may remember a story that was told. Oh, actually, I'll just quickly fill you in what I've been doing. So I had a webinar with Naos Asset Management this week. It's free on YouTube, where we had David Dicker and many other great CEOs appear from small caps. That's great fun with Naos Asset Management. Check it out. It's on the RAS YouTube channel if you want to hear from David Dicker and why he's the 5th biggest collector of Ferraris in the world. I think that's the thing that jumped out to me. Spoke to Joe Mager, who is a long-time guest on the show. He's now moved back to the United States. He's eating barbecue in Austin, Texas, as we speak, probably. He is now investing in early-stage businesses. So we talked about that. It'll appear on the podcast soon. And that's about it, actually. Now, you may remember a story from a little while ago. There was a story about a certain person that Drew happens to know that had $100,000 go missing from their account. Now, this person was able to recover some of the money.
About 65%.
About 65%. So rough figures, 65,000. So now this
That's
person.
why I'm the economist and you're the analyst.
So this person realized that there was money going missing from their account, and what they did was the people, the thieves, the whatever you want to call them, got the money from this person's account and switched it to another Australian bank account that they had control over to then, I guess, take it somewhere else.
Yep.
Over to you.
So slowly the bank was seemingly able to recover a significant amount. I'm not sure whether insurance or anything else, and a lot of it came back. I mean, there's still 35% remaining outstanding. But they got a call from the police saying they'd found the people who had committed the fraud or the scam.
Really?
And they were Australian-based.
Australian?
Yeah, which is kind of a shock. I think the issue you'll find, though, is that there's still no way of recovering the rest of the money. We've seen cases in the past where like the police will give you the option to say, well, you could sue them, but in most cases that money is long gone and disappeared, or they would easily have hidden it and become bankrupt, essentially. Right? Exactly. But you could sue them civilly to get that money, but we know that the court's quite expensive to try and pursue that sort of thing. So reasonably positive result from where it started for the close personal friend.
Wait, so reasonably positive result. So still 35 grand down the sinker.
Yep.
But they've got criminal charges.
Yes, they do.
Right. I would never have thought that if you
How
got a
is it
phone call
possible?
saying, "G'day, Mrs. whatever your name is, can you just transfer some money over to blah, 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 this is the bank speaking," and you would do that, and they would be Australian.
Yep.
Maybe I just have a too
You
high.
trust
of
us,
a-
yeah.
Like if a guy in an Australian accent called me, I'd be like, "Yeah, mate, it's Gavin from the bank. Can you just transfer some money?" "Sure, mate."
Sure, yeah, you'd be
we go,
legit.
"No worries, yeah,
Not
cool."
worried about you.
Yeah, cool. I only get put off if there's like that really weird popping noise at the beginning. It's pop, and then you know it's like connecting to some telegraph pole somewhere in the world. Anyway, okay, so good news, great news overall. If you do want to write in a question to us, we'll get to those in just a moment. You can send it via your podcast player. We are getting heaps of questions now, which is truly awesome. We do love them. We try to get to most of them, to be honest. But you can send the question in via the link in your podcast player. So if you're listening on Apple or Spotify or Google or wherever you're listening, those are our three biggest. Just hit the podcast player link there. It will say ask a question, select the Australian Investors Podcast, and Drew or I will give that a crack. Really important to understand that if we do answer a question that happens to be sent in, is strictly limited to general financial advice only. It is not personal financial advice. Why? Because we don't know your personal circumstances. So make sure that you see a financial planner, such as Drew here or the team at Waddle Partners, or any financial planner that you trust, to get that personalised advice for you, which can take into account your needs, goals, or objectives. Whew. Okay, without further ado, you can also read our financial services guide at ras.com.au/FSG. Buy, hold, sell. Let's move into this. Yes. Buy, hold, sell. We do a buy, hold, sell segment here on the Australian Investors Podcast, 2 cents format every Saturday morning. Why? Because the rest of the industry does it. And B, because it really adds no value. It's just a bit of fun. So buy, hold, sell, Drew. Qantas flights.
I'm a sell Qantas.
Sell Qantas.
Yeah. I don't know. I think just post lockdowns we switched to, or we pivoted to Virgin.
Yeah.
Maybe it's because I now have reasonable membership there that I get the perks and I'm not going to leave.
Yeah.
But I think there was just a period where Qantas was late for everything. I think they've reversed that now, but I kind of lost a bit of that luster and kind of loyalty. So I'm sell Qantas, buy Virgin, not the IPO.
Yep. We're not talking about the stocks. We're talking about the flights. I'm convinced people that fly Qantas don't pay the bill.
Yep. So, all business travellers and trust fund hippies, is that what you're saying?
Trust fund hippies. As someone that pays the bill, I do Virgin at best.
Don't you have a trust? Is that why you were flying Qantas?
No, I once caught a flight. I once caught a flight on a Qantas flight. It was the Australian Army sending me home.
Have you tried Rex?
No, but you haven't. How was it?
Okay.
That's a very...
I won't be negative. Let's put a hold on Rex.
Okay, hold on Rex. Buy, hold, sell. Health insurance, Drew.
Buy, long buy.
Okay.
I don't think I've, like any mid-30-year-old man until recently.
Okay, that's interesting.
I thought I was invincible and had never claimed on my health insurance for 15 years. And then within the period of about 8 weeks, there was a dentist trip, there was an optometrist trip, there was multiple physio trips. So, as the body ages, private health insurance, it's a buy.
And if you're over 30, or if you're 30 and you're thinking that you might eclipse the 75 grand a year, or it's a 90 grand a year, and 180 for couples, that's off the top of my head, could be wrong, check the ATO website. If you are in that bracket, lifetime health cover loading kicks in at 31 years of age. So what that means is you start to pay more for every year that you do not have private health insurance. So if you think you're going to earn over a certain amount, you'd be wise to consider it. Good idea. Buy, hold, sell. Shrimp on the barbie.
No, I mean, maybe I don't clean my barbecue well enough, but I prefer to do shrimp on the stove.
Yeah. What?
Not on the stove, but on a pan, not the barbecue.
How do you cook shrimp?
I don't cook it a lot, to be honest. Usually it's frozen and putting it into something else. So sorry for all the seafood people out there.
I don't like cooked prawns. No? So I would say this is a sell.
Oh, it's a weird buy-sell hold to put in if you don't eat cooked prawns.
Why are they bringing it in? Because last week we did a bit of Aussie slang. We did like the Harold Holt when you go a bit missing.
Missing. Billy Zane. You know the Billy Zane?
No.
The Phantom?
Oh. Yeah. And I thought shrimp on the barbie was one we didn't get to last week, and we can thank Paul Hogan for that.
And there was the Phantom came out a long time. That was the other Phantom, like the
early 2000s. There's a few different
Phantoms
getting around town, and one of them I shouldn't mention on the podcast. Buy, hold, sell. Work from home. To preface this, Elon Musk said that everyone that works from home is a La La Land laptop, something or other.
I'm a sell generally on work from home, but I do get that there are times, like primarily I'd say we run service businesses that are client facing, so much importance in being in the office. That said, there's times where you need to be creative, where you need to block things out. So a little bit of work from home or work from pod or hide in here in our podcast room is kind of the borderline of that too. So I think I'm a sell on work from home.
Elon Musk said laptop class in La La Land. And he made this case because he owns a big part of Tesla. And he said it's not fair on the people that work in the factories that the people that work at the head office get to work from home. Now, I disagree. I think, yeah, fair enough. But I think hybrid work environments are the best because, one, I don't have to face as much traffic coming into the city. Two, don't have to book in at the cafe for lunch. Three, but in seriousness, I think some people are much more productive at home, as you said. Like Monique calls it going into a cave. Yeah.
She does not live in a cave.
She does not live in a cave, for reference, just to be very clear. But I too did get a lot more deep work done at home. And it's more productive rather than me sitting for an hour in and out of the city.
But the recording, like in person, is significant. You
Yeah.
have to do this in person. That's one of those. Yeah.
Yeah. When you and I record remotely, it's kind of like
So
there's like
disjointed.
It's like a big pause, and you're like, "What?
Oh God.
No, you go."
So
Okay, so Elon Musk, 6 of one, half dozen the other. I think we kind of disagree to agree. Questions now.
how long are we in?
We are 31 minutes in. This is the longest we've ever gone before getting to questions. So we may have to tighten up this ship a bit. Okay, so first one comes from Burrow Smorgasbord, who says...
Joe Burrow reference, the quarterback for the Cincinnati Bengals.
No idea.
I think so. Joe Shiesty, I think they call him sometimes as well.
Joe Shiesty.
Yeah.
Okay, well, that's a good reference. Thank you for clearing that up. A lot of these references I do not get.
Smoking Joe. Quite
Andrew Deremith.
Quite handsome.
Would you keep contributing to super if you were 57 and your balance was already approaching the 3 mil mark? In brackets, I know, good problem to have.
There's no $3 million cap, remember?
There's a $3 million cap. This one said mark.
It's not a cap.
It's not a cap.
Not a cap.
It's definitely not a cap. It's just when tax kicks in. Okay,
so the one thing you got to confirm here is that your balance is already approaching 3 million, so that must be 2 people, because under the current legislation, you can't make further after-tax contributions once you're at 1.7 million per person.
Yep.
So this would suggest that one of them might be close and the other one is below, or that they've got $400,000 before they get up to that 1.7 plus 1.7 limit. I think once you get to that, you don't have a choice because you can only make concessional or salary sacrifice contributions for that period of time. But in our experience, while changes will happen, we talked about it with Kate, which I think will go live in a week or so. The alternatives aren't that much better than superannuation. So if you're earning significant money and you're saving incredibly well, I'd push superannuation to the limit and then seek the alternatives, which I think you're going to, those 3 main alternatives that people are considering.
The 3 alternatives which we talked about at the ASA were trusts, like discretionary trusts. We talked about company structures, and we talked about insurance bonds, which we've mentioned. Insurance bonds can be a bit expensive, but they are a way to not avoid tax, can't say that, deflect or defer. If you have a financial advisor, you could explore insurance or investment bonds if you are, for example, a higher income earner and you tend to be for quite a few years. It also can be used when you get legal advice. It can also be used for things like asset transfer and a few other things. So
worth mentioning that the cap's set to go up. The actual cap, not the $3 million cap, is actually set to go up to 1.9 million from 1 July, I believe. So then you can get up to 3.8 million in total.
The same for, I can't remember.
Started at 1.6, crept up to 1.7. So this is the reverse. While we're talking about help debt being increased, you're actually seeing all the caps and thresholds for everything else increase at the same time.
Yeah.
And we have the basic rule, if you want to get as much into superannuation as you can, and this rule that you preferably have 2/3 of your wealth in super, given how good the tax advantages are, and 1/3 outside.
Yeah, I mean, I'm definitely not 2/3, so I'll
as you near retirement, sorry.
As you near retirement.
Disclaimer.
Yes. The other options, obviously, you could have investment companies and trusts just allow you to like hold assets and deflect some things in different directions. But that's where a good accountant or particularly a financial advisor which has the tax qualification That's a separate qualification. Drew's got that, by the way. That helps you consider the tax implications for investing. So Robin asked a question, maybe a reference to Batman and Robin. Don't know.
You're Batman.
Are you Robin?
Yep.
I don't know. I probably prefer Robin.
There can be two Batmans.
Can there?
Yep.
Okay, two Batmans. So where can I find? Where can I find secure high-yielding shares? I don't know.
I'm always wary when someone says secure high-yielding shares.
Yeah.
Like, are you thinking shares are secure? As soon as you put money into shares, it's going to be volatile.
Yeah.
And they're listed, highly volatile liquid assets. So, I mean, when we think about getting income from shares, we're very much about don't view it as a single share, view it as a portfolio, and have as much revenue, sector, geographic diversification in those income sources as possible.
Yeah. Yeah.
You're doing the Charlie Munger answers?
I am. Yeah, I was going to try and put on a Charlie Munger-esque way of answering questions. So
put it on me.
Warren Buffett here answers the question, then Charlie Munger just says,
nah.
Don't know.
I'm out.
Or just doesn't respond.
Or wakes up.
No, but so high-yielding shares, I just say there are a few things really quickly beginners get sucked into. One, the first thing is they go for the shares that yield the most, like they have the highest percentage. That's a mistake. Second of all is they use trailing earnings. So like they look at last year's dividend as a basis for what happens in the future. There's no shortcut. You've got to understand the business. You've got to get the business right. Obviously, if you go with Commonwealth Bank, as shares, you can pretty reasonably, pretty confidently assume that they're going to pay a dividend the next year.
Unless a pandemic comes.
And they might cut or something like this. So even the biggest companies aren't guaranteed. So secure is definitely not a word that I would use for an individual share. Maybe as an overall portfolio, you would get close to quote unquote secure because you'd have 50 shares or something like that, or 100 shares in a diversified portfolio, which is actually a good segue into the next question, which comes from 50 Shades of Hay, this is a good one. Hi guys. Thoroughly enjoyed the podcast. Normally find me listening when out on the tractor working the farm. Buy, hold, sell? ? Debt recycling. If you had the income to cover the extra mortgage cost of the expected income, it's like dividends, was to drop or disappear. So if you had the income to cover the extra mortgage cost, if the expected
income was going to fall. So if you weren't worried about dividends being cut.
Okay, so you could make up the extra cost. Okay, also, if considering this strategy, what would you be inclined to invest the funds into? Blue chip shares with a strong history of paying a reasonable dividend, ? The Vanguard High Yield ETF, VHY, or a diversified ETF like the Top 200, or something else that I've missed. We can't give personalised advice, even if you are on the tractor, which would be very nice. So buy, hold, sell? I'd say hold.
On debt recycling?
Yeah. The reason I say that is some people, it's not good. Some people should consider it.
Yeah, exactly. I think you got the right perspective here, though. So not just thinking about debt recycling for the income.
Yeah.
Because the risk in any leverage strategy is that you're only paying the interest, and the whole purpose of this is to find growth. Same as if you're investing into investment property. So getting the blend, not focusing solely on the highest dividend paying, but making sure you're buying productive assets, and that leverage money is going towards income and growth. And that's one of our golden rules that you've got sitting in front of you. I plus G equals
TR.
Exactly. Total return.
Oh,
there's
okay.
2 parts of every return.
Yeah, right. When I was on the farm, I used to have a motorbike, a TTR. Wasn't
Good
great.
segue.
Yeah. But okay, so seriously, yes, I think the key thing about this debt recycling question for me, Drew, is, as you alluded to, the risk element. A lot of people think of debt recycling as like, it's a great strategy to grow wealthy, but there is a downside to it. You can't make the repayments. Something goes wrong, your investment isn't great, and you're left with a mortgage.
Exactly.
So
where you change your mind.
Yep, change your mind. So this is actually a really interesting way to think about it, and I think I would be going with something diversified. I think we spoke about this previously, something like the Vanguard High Yield ETF. But you don't have to just do one thing if you're recycling. You can do a whole portfolio, and that's perfectly fine. And so that's something that I'm going to consider in a few years as well. Good question. So Mean Striver says, this is a good question. It's about a new product. It says, hi, Rascals. The new Betashares BGBL ETF looks like a serious competitor to VGS. It seems to be very similar, but I'm not sure if I'm missing something, and I'm also wondering what other factors/risks to consider with such a new ETF. Thanks for all your great work. Cheers, Mean Striver. I always get concerned when they sign off with their name in the question field because it actually makes me think that this person's name may be Mean Striver. Anyway, so yep, new ETF, got an email from Betashares the other day, caught up with them in Sydney last week, and the Betashares are going after the other competitors. They've gone after all of the other products and they're
Vanguard, iShares,
and they're really trying to force everyone into a corner to say, well, we're lowering our fees, and if you don't do, it's like they even did, like they've got the thing with VanEck with the Qual ETF, they did something like Quality.
Slightly, yep.
They did something, I can't remember what was the other product they did. Then VanEck actually launched a similar gold product to Global X. Like it's very, like we're seeing it's heating up. Do fees need to keep falling? I feel like they're pretty good already.
The challenge of falling fees is the profitability of that company, and they have to keep getting more and bigger and bigger and bigger to keep reducing their fees further and further.
So Betashares...
Not that saying that they're not profitable.
No, they probably are, to be honest. But this is one of the things that I was very concerned about with Betashares. I always thought that Vanguard would just completely annihilate everyone because they've got the lowest fees and they're the biggest in ETFs. But, Betashares have really taken it to them.
This was the gap, though. Yeah. Like global MSCI. So every active fund that we invest into is benchmarked to the MSCI. This isn't the MSCI, let's be clear. It's Sol Active, but it's very similar to the MSCI. And Vanguard's the only group that's had an MSCI tracking ETF for global shares. Yeah,
so this is a 1,500 shares, same basic thing. So basically what the fund managers are doing now, for anyone that doesn't understand what's happening, is they're making money off their existing or their big products, and they're using it to subsidize some of these super low cost funds that come to market. And they may not, I don't know, but I'd imagine for the price of this ETF in particular, they're not making money on it right now. No. Not until it gets very big.
When the investor wins,
they might not make
like
money.
8 basis points for global equities, the investor wins.
Yeah.
And you're getting more. I think I can't see it slowing down the new issuance of ETFs and having a broad range of choice.
Well, why wouldn't any ETF provider just see what's currently working the market and say, well, there's no competitor for that ETF, so I'm going to build exactly the same thing thereabouts and make it cheaper.
I think it's also a sector that's growing where other parts aren't.
Yeah.
So ETFs, the sector itself is growing significantly, so you don't necessarily have to take money from Vanguard to win.
Yeah,
in
everyone's
this case,
winning.
New money can go into new strategies.
Yeah, good question, Mean Striver. Yeah, it's a serious competitor. I still use IVV, but this is now really interesting to me. So not here to... Farm Spiders says...
is this someone that... this is...
Okay, here we go.
This is a comment that's used regularly. It's another Australian slang word.
It's another Australian,
a little too often in some work environments,
Yep. Hey, Owen, Drew, and Andrew. I'm, in brackets, sort of, new to investing and have so far just picked 4 index ETFs that tickled my, in brackets, evidence-based fancy. However, I realize they are very much US-centric and overlap too much, so I need to change things around anyway for the good D. With my only Oz exposure being DHHF, which is a diversified ETF, by the way. 2 questions, really. 1, is it better to invest in more Aussie-focused ETFs or go for something that's hedged? 2, why, outside of the inherent greatness of being Australian, that's a joke, would it be good to have an Australian exposure when it realistically makes up such a small % of the world market? ? So, there are a few things here. Drew, get your 2 words, please.
It depends.
Thank you. There are
2 best words in the English language.
There are a few things that have been mixed up, I think, a bit here. Like you wouldn't compare an Aussie-focused ETF with a hedged ETF.
No. Maybe you're meaning diversified. I'm not sure.
Yeah.
Yeah.
Yeah. Australia is great. I would probably push back on that. So, and why would you invest in it when it makes up a small percentage of the world market? Well, that's a good question. Maybe we can tackle that one. I don't know, Drew. Like, why would you invest in Australia when it's only like 3% of the global share market?
This is why I say it depends. And it really very much depends on what you're seeking to achieve. Like I can't really say that it is today. Oh God, a young and medium height person, average height person. My objectives for my superannuation, where I'm holding my ETFs, are very much growth. And I look in Australia and I don't see as much growth. Yeah, there's some Xeros, there's some companies. I don't see them as being the quality of the growth that I can find overseas. So going to buy Microsoft, going to buy Apple, going to buy Amazon, Palo Alto Network, all these kind of massive secular growth and thematic opportunities. I see so much more growth overseas. But if you're like a lot of our clients in retirement or nearing retirement and you're starting to think more about the passive income, where you need a bit of a blend of Australia, and you should have a bit of a blend of Australia and overseas. And part of that reason is because there's a free kick in the form of franking credits. Yeah. If you literally get an extra 1.5%, 2% for nothing by investing into an Australian company paying taxed dividends.
Yeah, good, very good comments. Good way to tackle this question, because we've kind of gone with the question as if we've assumed what they've said is correct. Like, as in, we've taken what they already have and tried to, I've thought about it as a response to that question, but I think Drew's response here it's better than what I was going to say, in that let's disregard what you've already said and basically said, let's go back to basics.
Yep.
What are you actually trying to do?
Yep.
Because if you want some income, well, you probably want Aussie shares and you probably want some bonds. If you want to lower the risk of the portfolio a little bit, yeah, you're going to get overlap no matter what. If you have a diversified ETF like DHHF in your portfolio, you're going to get overlap somewhere in your portfolio.
Yeah.
If you have other share ETFs or something. So you're going to have some overlap. I don't think people need more than one diversified ETF. I just don't think you need that. Like, one's enough, because if you've got, say, DHHF and VDHG, you're going to get growth assets and some bonds in VDHG. There's a bit of a generational divide we see. I think at the ASA you probably saw it as well.
Yeah. Where the younger generations are more than happy to have no home bias, so they're not just investing in Australia, because they see the companies they deal with or work on every day are global. Whereas the older generations have a home bias where they're more comfortable because they know CBA, they know Woolworths, they know all these, bricks and mortar.
But they've also seen the implications of what happens when there's no globalization.
Yeah.
So the last 3 years, 30 years, everything's been pro-globalization,
yeah.
Right? And then we saw like the Trump era in the United States and the Australia-China trade war.
Not to get bringing Trump in.
Not to get too political, but we saw that.
Yeah.
And that's probably the first when the people under 40 have had an insight into, well, what happens if trade negotiations break down?
Yeah.
What happens to my companies, if this breaks down? So if that's the case, then you do want some local assets.
Yeah, a bit of both.
Yeah.
Or like always, diversification. And this is where it comes back in: income, Australia, growth, overseas, total return.
Well, that's one of your golden rules. But the other golden rule is number 8. I don't have number 9, as I said, because I think that the printer ran out of ink. But at number 8, you've got don't bet the house on your base case. And I think that's what this person may be thinking is, my base case is that companies overseas are better.
Yeah.
What is if they're not?
Yeah, exactly. Building resilient portfolios.
Yeah. Good question, though. Knowing Hacks and Rude Dirty Mouth says, it took me a while, but I've cracked the code. The number of times you say, let's unpack this, is an indirect way of telling us to set up an unboxing channel on YouTube as a side hustle. And clearly, you want us to invest in Unilever due to the number of times you say, depends.
Are they adult nappies? Oh, no.
I think they do other things.
Incontinence, yep.
Yep. I know you can't give specific advice, so I appreciate the codes. Thanks, bros. You're my favorite finfluencers. Well, cheers.
We're still waiting for our first brand ambassadorship, so...
That's it. Well, actually, now that you've mentioned this, is a good segue into thank you, Cobram Estates, for sending us this lovely...
whiskey.
Looks like gin, but it's actually olive oil. First Harvest, limited release 2023. Come from... Let me just get it out of the box. It's come from Rob, Sam, and Leandro. Thank you for sending this wonderful harvest. I'll just leave that here on the table. And also to Rumble Coffee Roasters, sponsor of the Australian Business Podcast. Send us enough coffee beans for the office every month. Got the Guatemala blend. Thank you very much. Okay, enough of that product promotion that was unnecessary. Help me, Rhonda says, "Hi, gents. I have a tough question. I have an SMSF of core ETFs and satellite ETFs. It's working well. I'm about to sell my house and travel Australia, and will have a nice chunk of money to invest. I don't want to double up on the ETFs I already have. Is it a case of A200 in the SMSF, so VAS in the outside of the investment portfolio? If I believe A200 is better than VAS, why would I invest in VAS? Love the potty. Keep up the great work." My response, pretty simple. Don't overthink it. Pick one. Pick one of the ETFs. Stick with it. Go and enjoy your travel.
Yeah, they're pretty much the same thing. Like maybe they won't like me saying that, but they are, like the A200 versus the A300, you're not having a significant difference in performance when you think about it that way. The more powerful impact on your returns is going to be your asset allocation and how much risk you're taking. So,
yeah. And also the decision to sell the house could be impactful.
And it's not always given, there's a slightly higher transaction cost because you're buying two things rather than one, but it's quite minuscule when you think about the long term, how long you're going to hold that for.
Yeah, I mean, you could diversify broadly. So you're comparing two Australian shares ETFs. You could consider diversifying and ask your financial advisor about this, like having ETFs from different providers, but you could have, say, an international shares ETF that's from iShares and an Australian one that's from Betashares and a bond one that's from Vanguard or something like that. If you're really worried about the individual providers or something, ask your advisor about that. But also when you go on your holiday, make sure you listen to all 4 RAS podcasts every week so we can maintain our downloads. Thank you very much. Also, I would get financial advice, Drew.
Indeed.
I would, because if I was selling the house and if I was only going for less than a year, I would consider the frictional costs involved in selling a house.
Stamp duty and the like, yep.
And then what's going to happen when you come back.
And you might need help to do things while you're away, and it depends if you've got Starlink on your caravan or not. But
yeah, I got a Starlink.
Might need help too. Yeah, I've heard.
Yeah, it's not bad. I would have got the new one had I known that it was going to come out in a few months, but that's okay. This one is interesting, so I'll just give it lip service. Rafe says, "I currently work in real estate private equity. Within our main markets, we invest in sub-markets that exhibit lopsided supply-demand of A to B multifamily assets. I would like to highlight the benefits of investing in the same for conservative real estate investors." My comment is, that's nice. Thank you very much. Next question. SMA art or smoke and mirrors? This is a great question. This is probably my favorite for this week, and I've only got a couple more left. Confused about the benefits of, quote, new age SMA versus unlisted managed funds or ETFs. This one will really get the party started. Various platforms and advisors sell the benefit of SMAs. There appears to be some benefit if there are a lot of investment switches in a high tax environment. For example, if you transfer your assets, optimizing for capital gains tax, etc. But in a super environment nearing retirement or in retirement, do SMA offer much upside versus simpler managed funds / ETFs? Now, we need to clarify, this is it's not that technical, but you just need to understand the jargon. So, SMA stands for separately managed account, and a trust is just like an ETF, except you don't get it in an ETF form. You can just buy it through going straight to the to the fund manager. Now, typically, an SMA is used by, say, like a financial advisor or an investment manager to create a portfolio. Within that, you could have shares, you could have other ETFs, you could have funds within the SMA as well. So you could have like one fund here, another fund there. Now with unit trusts, which is what most people listening to this know, which is like ETFs, they're a form of a unit trust or an investment fund, like say Magellan as an example. With those, they're typically single strategy. Not always, but increasingly single strategy.
Yep.
Meaning that you would invest in a fund and you would only get Australian shares or an Australian small cap fund. Whereas SMAs have a very broad remit. Now, there's not... did you want to explain the actual under the surface, the difference?
Well, we're actually building our own SMAs at the moment. So maybe the kind of reason we're doing that and the backstory around it. So there's multiple things, SMAs, managed accounts, they're all kind of the same concept, and it's similar to an ETF or a fund, is that the person making the investment decisions is having discretion and the ability to implement those changes straight away. And you need context for that. So as a financial advice firm, we have no discretion. we provide a recommendation to every client every quarter. They have to approve that, and then we can implement it on their behalf.
Yep.
Naturally, there's clients that we've had for 15 years who trust us implicitly. They're happy with everything we've done over that period of time, and they're sick of the friction. So friction can be, if they're still holding managed funds, you have to prepare forms, mail them out, get them back, lodge them, transfer money, like this extensive. It can take 4 weeks from the provision of advice to it being implemented.
Yep.
And we know that timing or being in the market is the most important thing. So the SMA, from our view, is those clients that are comfortable with the way we think, know how we think, get the benefit of that discretion and able to implement, not have to worry about. They'll still receive reporting, still know everything we're doing, but they won't have to do all the paperwork that comes beforehand. So it's this efficiency, but also the benefits of being able to implement things more quickly for the client. And I think there's data that shows that can add significantly to returns over the longer period of time. But then you've got the benefits of CGT, trading across all of your shares in BHP or all of the same fund at the same time. And then a big one that probably less understood is the ability for us to then negotiate discounts not on ETFs, but on other investments, so reducing the end cost.
So, for example, if you're investing in a managed fund, you might be able to go to the fund manager and say, hey, we want to pay less than what you're advertising.
And these SMAs aren't off the shelf. They're only via financial advice.
So the thing is to keep in mind, so there's a lot of benefits. So Drew explained the benefits of why they would use an SMA. But one of the benefits is actually when you log into the SMA, either as a client or as an advisor, you can actually see which shares of BHP you own and which ETFs you own. Whereas if you get a unit trust and you just give your money to a fund manager or an ETF, you just see that thing going up and down. You don't actually see what's inside it. Whereas with an SMA, you see what's inside it, which means that you can manage it for tax reasons, which is a benefit. Now, I want to be clear, like these things aren't cheap to run. The platforms, if you just look at like Premium, Netwealth or Hub, Premium's not so much ananymore, but the other two are listed on the stock exchange. You can see what fees they charge. And these fees are charged to the client via the financial advisor. And these can be 0.2% to 0.3%. So there's another question that started, we might not have time to get to it, but there's a question about percentage fees for advice. Of course, like a lot of people prefer flat fees or fixed fees.
That's our entire business is fixed fee.
But this cost is the reason why a lot of financial advisors do percentage-based fees. Because if the financial advisor has to pay 0.3% of your portfolio in costs to Premium or to whoever, they have to recoup that cost somehow. So I had a whole spiel here about how much it actually costs. If we were to launch SMAs versus a unit trust, like we were to create our own managed fund, it would cost us a few $100,000 just to launch the managed fund versus an SMA, which you can kind of like onboard pretty quick. So this is why we have fees in financial advice and in investing, is because they're so expensive. I just say that as an illustration. But for retirement, Drew, it's clear that like an SMA has more, for an advisor, it has more flexibility.
Definitely.
And that's why they're used. Otherwise, you've got to log into people's accounts, do this, that, and the other all the time. Okay, so maybe we've got time for 2 more questions, Drew, because we've got a lot on this list. So maybe we can go with, okay, why don't we just do one more? And I think this is a really good one, the last one.
Oh, good. Not the next question, because I was a bit afraid to say that.
The name referenced female genitalia, which was not a very, but they did say in their defense that the investing Q&A seems dominated by male genitalia. So
maybe you should say the name.
No, thank you. So MC4D says, and then Dollars Disco Dividend Dynamo. Drew and Jamie from Waddle Partners, never heard of them, have spoken about previously using buying beta next to zero with ETFs and using active fund managers for generating alpha. Where might some good resources be when researching active fund managers for Aussie-based small/microcap shares or global equities? So just before we get to your response, Drew, so I'm going to quickly read off some of these. I've only got the 8, so maybe next week.
Under pressure.
Maybe next week we can go
bring
into
up
the
number
9.
9 if you like.
Okay, you get 9. I'll do the first 8. So the golden rules from Model Partners are as follows. Asset allocation is paramount, so I haven't read it, but this looks like picking like how much shares, how much bonds, whatever. Number 2, beta is free. So basically saying that the fees are so low on just vanilla index fund ETFs that you barely even notice it. Number 3 is smoothing the ride, which I assume is about volatility and building a diversified portfolio.
Yes.
Number 4 is be agnostic to product. So meaning that you just invest in whatever it may be. You just invest in the best thing.
It's not or, it's and.
Yeah. So it's not about saying we do only index funds or we do only small cap shares or we do only growth investing. It's everything. I plus G equals TR, which is the total return. A lot of people just focus on the growth of their portfolio or they focus on the income they receive. Drew's trying to find something with his computer over there. Number sounds like you're playing, what's that, Pong?
Yeah, I'm not going to be able to find the golden rules, I'm sorry.
Number 6 is define the game you are playing, which is about the portfolio and strategy. Number 7 is things will go wrong. Really important to remember. Number 8, don't bet the house on your base case, which is to someone's question earlier on about having like only overseas shares. It seems a bit, it seems like a lot. So we'll come back with number 9 next week.
That was about the power of rebalancing.
Oh, the power of rebalancing.
Yeah.
There you go. So there's a great list. I'm sure it will be available on the new Waddle Partners website when it is firing. So to answer the question, where do you research? So we've got our core portfolio of ETFs. We've got that. We know we can download the list from the ASX and we can suss the returns and the fees and all this sort of stuff, see what's in them. How about for active funds, Drew? Where would you go?
It's actually incredibly difficult. So as an advisor, it's easy. We have Morningstar, then you can use Lonsec, Zenith, SQM, and there's a few other groups, but none of them really offer, or not many offer, a retail or direct investor option. Yeah. So we can just go to them and get a research report that covers every small cap fund in the country. For retail or direct investors, there's things like, as a starting point, you could use InvestSmart. They've got a managed fund listing, which has some link to Morningstar, or Investment Centre, I think is part of the money management. That is literally only a listing. But what you can do is pick up the asset class and get a list of all the funds in that asset class, which you can then use to go directly to the website of those funds and try to find the information you want.
Yeah, that's probably the thing. With a lot of small cap funds, actually, they fill up very quickly. So if you're looking for Australian fund managers who are good, that invest in small companies, oftentimes they don't even make it to Zenith or they don't make it to Lonsec because by the time they even get there, they're already full. Yeah, the advisors and everyone has already invested in them because they can only take a small amount of money relative to how much demand there is. So if you're a good fund manager and you want to operate in small caps, I think that's the way to go. Definitely. Yeah.
And then when you talk about beta is free, when we're looking for alpha or active fund managers, we look for something called active share or tracking error. So how different they are to the index and whether that's whether you're trying to duplicate the index or whether you're looking at the sectors or revenue sources. It's multiple views on diversification, not just on the 10 key holdings within the fund.
Yeah, the overall portfolio. You can use Morningstar as an individual investor. Just so you know, you can use morningstar.com.
I think it's the only one, isn't it?
Yeah, it's the only one where you can log in and you can see the different funds and whatever. The ASX is starting to emerge as a place where people can access funds, but you don't typically have small cap funds in there. Yeah. So you can, I think Morningstar, if you go back to the Monica episode that we had from Morningstar, we talked about the 5 sources of moat. It was about 3 months ago. There was a link in that episode that Mark gave to us to get it. I think it was like 40% off or something off a Morningstar subscription, which is already pretty cheap. So you can go and check that out and it will allow you to use many of the tools. You'll be able to see the style of a fund. So it will like plot based on what it's invested in.
Value growth, size.
Value growth, size. Like what is it actually that you're getting? It will also show you like the metrics of the portfolio, like the risk, the return, and you can compare. That's probably the place to go. But these are all great questions. Thank you so much. We do have to do 2 things. One is Andrew Deremith, Dr. Andrew Deremith will prepare a quote. If you do work for Forbes, Financial Times, Bloomberg, New York Times, Wall Street Journal, any of these places, and you are looking for a reputable economist to quote in your upcoming article, please get in touch with Dr. Andrew Deremith. You can find a link in the show notes, or you can just head to the Rask contact page and we will get him quoted in your publication. And so, Drew, we've got to choose the best name. There was Burrow Smorgasbord, which I had nothing. 50 Shades of Hay, Mean Striver. I'm not going to say that next one. Don't want to say that one either. Although this one wasn't too bad. Help Me Rhonda is a good one. SMA Art, Smart, or Smoke and Mirrors.
I like that for the quality of the question.
All right. Smart, or smoke and mirrors. You've won the Value Investor Program. Please write into us however you can reach us, and you will get a $499 course on us. Okay, as always, you can get in contact with Waddle Partners Financial Planning. There is a link in the show notes. You can find out more about me and the RAS team in the show notes. Find us on Twitter. Almost at 10,000 followers, Drew, I realised the other day.
You do?
Yeah, I know.
Have you paid for your ticket?
Yeah, I did, yeah.
You did?
Yeah, I can now upload 8 gigabytes of video, says Lord Elon Musk. Okay, so take us away into the evening or morning with...
There are a couple of saucy ones, but I'm not going for the saucy one.
Okay.
I'm just going to keep it simple. How do you put a baby astronaut to sleep? You rock it.
Not bad, not bad. I was thinking something space related. You know the camera's
Like
on,
a rocket,
right?
yeah.
Oh, gosh. All right, well, thanks for joining us, Drew. Really appreciate it. And thank you, everyone, for listening and watching in. If you watch us on YouTube, Monique, thank you for putting together the video at last minute. Didn't intend to do it, but thank you very much.
Credit to you, Monique.
Credit to you, Monique. Unprecedented, if you will. So, Drew, thanks for joining me.
Good to see you.